Something unusual is happening in the housing market. Right now, more homeowners are searching online for answers because they cannot sell their homes. And those searches are higher than during the 2008 housing crisis. That should immediately get your attention, because we are not officially in a financial collapse. Yet, sellers feel stuck. Homes are sitting longer, price cuts are increasing, buyers are hesitating, and investors are unsure what move to make next. Is this the beginning of another crash? Or is this a strategic opportunity hidden inside market fear? If you are building wealth through real estate, you cannot ignore this shift. Because when homes stop selling easily, power moves from sellers to buyers. And whenever power shifts, opportunity appears, but only for those who understand what is really happening. Today, we break down the real reasons homes are not moving. We analyze what this means for prices, for rental demand, and for long-term wealth building. The lock-in effect is real. Millions of homeowners are sitting on historic lows, making it nearly impossible to justify a move to a 7% rate. This lack of movement has created a supply vacuum. Even as demand cools, the scarcity of inventory is preventing the price crash many expected. For those building wealth, this means the rental market is becoming more competitive. High prices and high rates are forcing a generation into long-term renting. We are seeing a unique phenomenon, low volume but stable prices. The market isn't crashing, it's recalibrating to a new normal of higher costs. Strategic investors are now looking for motivated sellers, those who must move due to life changes. This is where the true wealth-building opportunities lie today. By the end of this video, you will know how to position yourself in this changing market. The power is shifting. Make sure you're ready to catch it.
To understand why homes are not selling, we must examine three powerful forces shaping today's market. The first force is affordability pressure. Home prices climbed rapidly over the past few years. At the same time, mortgage rates increased from historic lows. Even if rates have stabilized slightly, monthly payments remain much higher than before. Buyers do not focus only on price. They focus on the monthly payment, and payment shock is changing behavior. A property that once required a manageable payment now stretches budgets too far. That factor alone slows demand in today's market. The second force is seller expectation. Many homeowners still anchor their price to the peak of the market. They remember neighbors selling quickly. They expect similar results to what they saw before. But today's demand is different. When sellers price based on yesterday's highs instead of today's data, homes sit. And when homes sit, buyers gain leverage. The third force is rising inventory. More listings are appearing in many areas, but buyer demand is not rising at the same speed. When supply increases faster than demand, negotiation power shifts. Buyers begin requesting concessions more frequently. Closing cost support becomes common. Repair credits increase as negotiations continue. Sellers must adapt or remain stuck. This is not automatically a crash. Unlike 2008, lending standards are stronger today. Most homeowners have fixed-rate loans. Many homeowners hold significant equity in their properties. This is a demand slowdown, not a structural collapse, and demand slowdowns require strategy adjustment.
Now let's go deeper into what this slowdown really creates. When homes stay on the market longer, emotional pressure builds. Mortgage payments continue regardless of the market slowdown. Property taxes continue to accrue every single month. Insurance costs continue to be a necessary ongoing expense. Uncertainty increases stress for many homeowners and sellers. This is where investor opportunity begins. In fast markets, buyers compete. In slow markets, sellers compete. That difference changes negotiation power. When a property sits for 60 or 90 days, flexibility increases. Sellers become more open to lower offers. They may offer rate buydowns. They may also include various seller incentives to close the deal. Even if list prices remain stable, the effective purchase cost drops. Another important shift is rental demand. When potential buyers delay purchasing, many turn to renting. That supports high rental occupancy rates in stable regions. In some regions, it supports rent stability. This creates a significant and noticeable market divergence. Flipping becomes more sensitive to pricing mistakes. But buy and hold investing can remain stable. Real estate markets always move in predictable and natural cycles, and transitional phases often create the strongest entry points. The key question is simple. Are you prepared to act during uncertainty? Or will you wait until headlines feel comfortable again?
Imagine a homeowner who purchased near peak pricing. Back then, homes sold within days. Multiple offers were normal and expected in that environment. Now the market has slowed. The property is listed at a price based on past highs. Weeks pass without strong offers. Price reductions begin to appear on the listings. Frustration increases as the days on market climb higher. Holding costs continue each month. An investor studies the local rental data. Vacancy rates remain low. Rent levels are stable. After careful analysis, the investor makes a strategic offer below asking price. The offer includes quick closing and minimal contingencies. Certainty becomes valuable to the seller. Negotiation leads to a lower effective purchase cost. The investor secures a property with positive cash flow. Over time, if rates decline and demand returns, appreciation becomes additional upside. This is how leverage shifts quietly, not always through panic, but through patience and positioning.
Success in real estate isn't just about buying property. It's about mastering the underlying market dynamics and timing your moves with precision. Today, we are diving into 6 critical strategies that separate professional investors from the rest. Let's start with market timing. First, track days on market carefully. This metric is your window into the seller's mind and the neighborhood's demand. Longer listing times often signal flexibility. When a property sits, the seller's urgency increases, opening a door for better terms. Don't be afraid of the stale listing. It's often where the most motivated sellers and the best deals are hidden. Second, run conservative cash flow numbers. Your profit is made when you buy, so your math must be bulletproof. Assume stable rents, not aggressive growth. Banking on future appreciation is a gamble. Banking on current yield is a strategy. If the deal doesn't make sense at today's rates and today's rents, it's not a deal. It's a liability waiting to happen. Third, negotiate beyond price. While the purchase price is important, it is rarely the only lever you can pull. Ask for credits. Seller credits can cover your closing costs or buy down your interest rate, keeping more cash in your pocket. Ask for concessions. Whether it's repairs or including appliances, every small win at the table reduces your post-close expenses. Small advantages compound over time. A slightly better term today can result in tens of thousands of dollars in savings over the life of the loan. Fourth, maintain strong financing readiness. In a competitive market, your pre-approval is your ticket to the game. Speed and certainty win deals in slower markets. When sellers are nervous, the buyer who can close quickly and reliably gets the prize. Have your tax returns, bank statements, and credit scores ready at a moment's notice. The best deals don't wait for your paperwork. Fifth, monitor inventory monthly. Supply and demand are the 2 most powerful forces in any economic ecosystem. Rising supply may increase opportunity. As inventory grows, buyers gain leverage to negotiate more aggressively. Conversely, sudden tightening may reduce leverage. Knowing which way the wind is blowing allows you to adjust your offer strategy before it's too late. Sixth, avoid emotional reactions. Real estate is a numbers game, but it's often played by people who get swept up in the hype. Fear freezes action. Data guides smart decisions. When the numbers say go, you move. When they say no, you walk away. Align every purchase with your long-term strategy. The market rewards the prepared. Start tracking, start calculating, and start winning. The housing market is shifting, and one of the most visible signs is that homes are taking longer to sell. But for the informed investor, this isn't a cause for panic. This shift is a powerful market signal. It marks the transition from a frenzied, overheated environment to one that is more balanced and deliberate. Affordability pressure is real. Rising interest rates and sustained high prices have stretched buyer budgets to their limits, slowing the pace of transactions. Seller expectations are now adjusting. After years of rapid appreciation, homeowners are realizing that pricing strategy is more critical than ever before. At the same time, inventory is rising. As more homes sit on the market longer, the total supply increases, giving buyers something they haven't had in years: choice. Leverage is shifting. The lopsided advantage held by sellers is evening out, opening doors for negotiation and more favorable terms for those ready to act. In slower markets, disciplined investors gain influence. When others hesitate, the prepared professional finds value that was hidden during the boom. We've discussed the fundamental forces driving this shift, from macroeconomic policy to changing consumer sentiment. Understanding these gears is key to your success. We also explored how rental demand may remain stable. Even as home purchases slow, the fundamental need for quality housing remains as strong as ever. We examined the new negotiation advantages. Longer days on market mean more room to ask for repairs, closing cost credits, or price adjustments. And we've outlined strategies you can apply today. Success in this environment requires a data-first approach and a long-term perspective. Real estate wealth is built through cycle awareness. Markets breathe in and out, and your ability to recognize these rhythms defines your portfolio's growth. Preparation beats panic every time. By staying informed and maintaining your financial discipline, you turn market uncertainty into a competitive advantage. If this analysis helped you navigate today's complex landscape, subscribe to WealthWise Insights for more deep dives into the world of real estate investing. Like this video, so more investors can see this analysis and stay ahead of the curve. Your support helps us bring more clarity to the market. And comment below with your biggest question about today's housing market. We read every comment and want to hear what's on your mind. Because at the end of the day, informed investors build long-term wealth. Stay focused, stay disciplined, and stay informed. Thank you for watching. We'll see you in the next analysis. WealthWise Insights, where clarity meets opportunity.
If you found this video helpful, please like, share, and subscribe. Thank you for watching.